It is my pleasure to address the opening of this very important stakeholders meeting on the crucial 2021 Finance Bill, organized by the House of Representatives Committee on Finance. Let me profusely commend them for the time it has just taken them, rising from the day that I read Mr. President's letter on the floor to today that they have decided to call stakeholders meeting for the purpose of this bill being looked into. And let me also commend the painstaking work that had already commenced on the finance bill leading to this strategic stakeholders meeting to get the inputs of critical stakeholders drawn from the various public and private spectrums of our finance sector. Broadly speaking, this bill seeks strategic amendments to certain operational provisions of the Capital Gains Act, the Companies Income Tax Act, the Federal Inland Revenue Act, Personal Income Tax Act, Stamp Duties Act, Tertiary Education Tax Trust Fund Establishment Act, Value Added Tax Act, Insurance Act, Nigerian Police Trust Fund Establishment Act, National Agency for Science and Engineering Infrastructure Act, Finance Control and Management Act, and Fiscal Responsibility Act, and for related matters. Essentially, the 2021 Finance Bill seeks to introduce strategic and broad-minded positive reforms that will engender best practice, statutorily check borrowing by local, state, and federal government, enhance transparency and accountability in the administration in various strata of tax and public revenue generation, while at the same time guaranteeing the interests of the investing public and businesses. It is instructive to state that the essence of the 2021 bill is to further reposition our finance system to plug waste, close openings for corruption, create opportunities for employment, as well as stimulate stability and growth in our productive sectors within the wider context of our quest for economic recovery in our country. Given the democratic credentials of the House of Representatives under my watch, as well as the need to further deepen the credibility of the process through wider participation of stakeholders, this stakeholder meeting has been designed to give Nigerians and critical stakeholders in the industry the ample opportunity to own and drive the process. In this hall, we have very proficient professionals and experts who are stakeholders, investors, development partners, and interest groups have submitted memoranda and are ready to make contributions to this bill. It is on this background that I charge these stakeholders to extensively scrutinize the template in the bill in the general interest. We must strengthen the institution to strategically check reckless borrowings by ensuring accountability in the use of borrowed funds and ensuring that the borrowings shall be on concessional terms or at relatively low interest rates and subject to the rigors of legislations. The stakeholders should also consider the issues of chargeable gains as they affect individuals and companies in some of the proposed laws, so that we will achieve our aim to enhance transparency, accountability, as well as engender a credible and favorable business environment for growth in our economic productivity. I have no doubt that with the caliber of Nigerians, including my colleagues, in this stakeholders meeting, and the commitment of course, the Finance Committee, these stakeholders will be successful. On that note, I hereby declare this stakeholders meeting open.
The preparations for the Finance Bill 2021 to support the 2022 fiscal year budget was a commitment that Mr. President made while he was presenting the 2022 budget to the Parliament in October, on October 8. And in that presentation, he had charged our ministry to prepare a finance bill to support the budget. So this is the work, the basis of the work. And this same committee, I say, helped us in preparing the draft the Finance Act. The Finance Act, you recall, marked the very significant milestone which you passed into law for Nigeria that is aimed at bringing the country's legislation at par with global best practices while increasing revenue for government. The Act, if you remember, was hinged on 5 thematic reform areas. The first being promoting fiscal equity. Secondly, aligning domestic laws with global best practice. Third, introducing tax incentives for infrastructure and capital markets. The fourth is supporting small businesses. And the fifth was increasing revenue for government. So you recall that one of the significant provisions there is that it is the Finance Act 2019 that actually increased the VAT rate from 5% to 7.5%. It is also the 2019 Finance Act that exempted small businesses from paying taxes and also reduced taxes from company income tax from 30% to 20% for medium-sized businesses. There were several reforms contained in that act that have been very significant in terms of enhancing the fiscal space in our country. This a similar pattern continued in the Finance Act 2020, which was again predicated on essentially, because of the COVID-19 pandemic, introducing no new taxes and no incentives due to the COVID-19 impact on the economy. And that act was structured along 4 broad pillars, the first being enacting counter-cyclical measures and crisis prevention initiatives. That is when you approved the setting up of the 500 billion crisis intervention fund. You approved the setting up of the unclaimed trust fund, unclaimed funds trust fund. You also approved the companies that have donated towards the crisis to be able to get tax relief from the donations that they provided in COVID-19. The second broad area in the Finance Act 2020 was the reform of fiscal incentives for job creation, and that is where you had passed the provision for relating to fiscal relief relating to mass transit by reviewing some of the duty and levy rates of mass transit vehicles, also streamlining some provisions relating to agricultural equipment and also providing additional relief, exempting minimum wage earners from paying personal income tax. And the third broad area is tax fiscal responsibility and public procurement. So the Finance Act 2020 amended key tax legislations to enhance implementation of tax reforms and also amended some provisions of the Fiscal Responsibility Act. That was where you made the provision that pegged revenue to expenditure ratio of government-owned enterprises to 50-50, and we've seen significant increase in revenue, non-oil revenue, because of that provision. The fourth area is ensuring closer coordination between monetary and fiscal authorities, and part of this is empowering the FIRS to be able to obtain information from taxpayers utilizing ICT platforms. So there are several such provisions. So just to give you a bit of background, and this is how we journeyed to the current bill that we're discussing today. And this Finance Bill 2021 to support the 2022 fiscal year also followed, in fact, a more extensive consultation than we did in the last 2 bills because of the feedback that we got that the consultation was not enough. So from early in the year, from February, we had series of consultations. We had more in April, and then we have even more consultations in June. So the landing was that we prepared this draft bill along 5 reform areas. The first is domestic revenue mobilization. Second is tax administration and legislative drafting. Third is international taxation. Fourth is financial sector reforms and tax equity. The fifth is improving public financial management reforms. So the amendments that are in this, the provisions in this draft bill is proposing to amend the Capital Gains Tax Act, Company Income Tax Act, FRS Establishment Act, Personal Income Tax, Stamp Duty Act, Tertiary Education Tax Act, Establishment Act, Value Added Tax, Insurance Act, Nigerian Police Trust Fund, and the Fiscal Responsibility Act. So permit me, Mr. Chairman, although you have cautioned that we will stay short here, but I need to give some examples of each of these 5 broad areas. So let me start with, of course, domestic revenue mobilization. And one of the examples that I'm giving here is Section 1 of the draft finance bill is proposing to amend Section 30 of the Capital Gains Tax Act. What is the issue here? The issue is to roll back exemption of shares from capital gains taxes. And the mechanism that we seek to use is 5% capital gains tax imposed on shares disposal transactions where gains exceed 500 million naira over a 12-month period. Second is to reinvest, to encourage reinvestment of relief. And this is provided by deferring capital gains taxes to the extent that the disposal of the investment proceeds are wholly or partially reinvested. So where the case is so, then there will be no capital gains tax charge at that time. Taxpayers are also required to report disposals to the FRS. The rationale behind this is high tax value disposals are the target here, and also to provide reinvestment relief to encourage long-term equity investments. So we're trying to encourage investments that will come into the country and stay, not portfolio investments that just come, take advantage of the market and quickly run out. And then also to just emphasize that the pension fund is exempted by the provisions of the Pension Act from this particular provision. So the pension funds are protected because Section 10 of the Pension Reform Act of 2014 has provided such protection for pension funds. The second example I want to give is the taxation of oil and gas companies under the Petroleum Industry Act, the PIA of 2021. So this will be amending Section 6. The proposal we made in Section 6 of the Finance Bill, Section 7 of the Finance Bill, as well as Section 11 of the Finance Bill. And the essence is to clarify that oil and gas companies' dividends are taxable, that midstream and downstream oil and gas companies are liable to corporate tax under CETA and cannot benefit from CETA tax exemptions for firms exporting goods to earn foreign exchange, and also to prevent double dipping by gas utilization companies so that they cannot claim both 3-year tax holidays, provident tax incentives, as well as pioneer tax holidays under EDITRA. The provisions we have now actually allows companies to do that. So this provision is to close tax loopholes from the introduction of that has been inadvertently created from the passage of the PIA and the transition to oil and gas companies from the PPTA, the Petroleum Profit Tax Act, to hydrocarbon tax, as well as the company income tax. Using at Section 33 of the draft bill and Section 4 of the Nigerian Trust Fund. Currently, because there is no such provision, FIS has been unable to start collecting on behalf of the fund. And also to streamline the tax and the levy collection from the Nigerian companies in line with Mr. President's administration's ease of doing business, so that we don't have Nasani going out to companies to collect that tax. FIRs will collect on their behalf during their collection process, and it will be a pass-through to them. And the rationale for us is to provide an administrative framework to enable collection of the Nigerian Police Trust Fund levy on net profits of companies operating in Nigeria. So if I may now move on to the key policy trust number 2, which is tax administration as well as legislative drafting. The purpose here is to just make some amendments to previous finance acts and also some laws that are presented that and the essence is just to allow for better clarity and also make it simpler in terms of interpretation of the law. I'll just give an example. Section 17 of the bill amending Section 25 of the Federal Inland Revenue Service Establishment Act. And this is relating to FRS automation and CIT reforms. The mechanism here is FRS is empowered to sanction non-compliant taxpayers refusing access to their IT systems. FRS is enabled to deploy both proprietary and third-party technology applications to collect information from taxpayers. The reason, the rationale for us is to enhance ICT and tax administration reforms by the FRS. So the previous finance bill of 2020 has empowered FRS to be able to access IT systems of companies to be able to make analysis for the purpose of tax compliance. So that's an example. Secondly, the FRS investigation of tax crimes. Section 19 of the bill amending Section 35 of the FRS Act. FRS is empowered to do investigation of tax as well as investigation of evasion and other crimes that are related to tax. So this provision is to enhance the ICT and tax administration reforms by FRS and to strengthen the organization in its investigation activities. And also, let me just say, on the part of FRS, we strengthen the provision that compels the FRS itself to enhance confidentiality and non-disclosure provision of FRS by FRS staff of taxpayers' confidential information, and to provide some safeguards so that taxpayers' information are protected, and also wherever there is a non-compliance by a staff, there are sanctions that are provided to protect taxpayers. So if I may, Mr. Chairman, move on to key policy trusts area number 3, which is international taxation. The first example here is Section 8 of the Finance Bill, amending Section 30 of CETA, and the issue here is taxation of e-commerce business by non-resident companies on a fair and reasonable turnover tax basis, and, for example, at 6% of turnover. The mechanism here is to empower the FIRS to assess non-resident firms to tax on a fair and reasonable turnover basis based on turnover earned from digital services to Nigerian customers. And this will be introducing turnover tax on fair percentage of profits earned from providing digital services to Nigerian customers. Such digital services include apps, high-frequency trading, electronic data storage, online adverts, as well as several others. And the rationale here is to enhance taxation of non-resident taxpayers. Taxpayers that are doing active business in Nigeria, but they're not registered in Nigeria, they don't have fiscal presence, but they're doing good business from Nigerian customers. Another example is Section 28 of the bill amending Section 10 of the VAT, and this is relating to VAT obligations of digital non-resident companies. The mechanism is to restrict VAT obligations mainly to digital non-resident companies who supply individuals who cannot self-account for VAT, and also to reduce compliance burden on other non-resident taxpayers who are not required to register for VAT in Nigeria. So, for example, and so the essence is to enhance taxation of non-resident taxpayers. So, for example, we do transactions on Amazon. And what is proposed here is Amazon can now register as a tax collection, VAT collection agent for FIRS, add VAT on their transactions, and remit the VAT to the FIRS. If I move on now to the key policy trust number 4, which is financial sector reforms and tax equity. And the first example here is Section 2 of the Finance Bill, which is amending Section 9 of CETA. And this is relating to securities lending transaction reforms by the Securities and Exchange Commission. The mechanism here will be securities lending, permitting lenders to receive compensation, manufactured dividend from securities lending trading. And the rationale here is, again, to enhance tax equity, to enable securities lending reforms as being championed currently by the Securities and Exchange Commission. The second example is Section 5 of the bill amending Section 16 of CETA, and this is relating to minimum tax for insurance companies. And the mechanism here is to clarify aspects of the taxation of insurers, especially minimum tax on non-life business and COVID-19 rebate under Section 33 of CETA. The rationale here, again, is tax equity to provide further clarity of taxation of insurance firms as part of the financial sector reforms. If I may move on now to key policy trust area number 5, which is the public financial management reforms. And the first example here I'd like to give is Section 21 of the bill amending Section 68 of the FRS Establishment Act. FRS is mandated as a principal tax collection agency, and this provision is reiterating that. So we have so many agencies collecting taxes, but this is to reinforce the lead role of FRS as a leading tax collection agency. And the mechanism for us is FRS to be reaffirmed as a principal tax revenue collection agency and also enable FRS to have better collaboration with other law enforcement agencies that are currently inadvertently also collecting taxes through their own enforcement processes. The rationale here is tax administration and domestic revenue reforms to streamline tax collection processes under the FRS Establishment Act. Section 36 of the bill is amending Section 20 of the NASENI Act, and this is related to the NASENI levy. And the essence here is the mechanism here is to clarify the NASENI levy and enhance administration by the FRS. And the rationale is to align with the current realities and ensure that NASENI Act is actually implementable. The Finance Act also has provision number 36, amending Section 41 of the Fiscal Responsibility Act relating to sovereign debt management. The mechanism here is to introduce reforms to enable borrowing for significant and critical reforms of significant national impact at concessionary rates from capital markets. And also, the reason is to enhance public financial management through optimal public debt management reforms. The Finance Control and Management Act of 1985 is also sought to be amended through Section 36 and 34 of the Finance Bill. And this is, the issue here is supremacy of fiscal rules in the 1999 Constitution and other exempt money acts in the public financial management. The purpose here for us, the mechanism is to reiterate and reinforce the 1999 Constitution as well as the Finance Control and Management Act provisions vis-a-vis management of public finance and collection of revenues. And also, the rationale is to enhance public financial management reforms to reduce revenue leakages and better track actual expenditure to revenue. This particular provision is very important for us to be able to optimize revenue. The Constitution is very clear in its provisions that all collections should go, first of all, to the Consolidated Revenue Fund and then distributed from there. But over the years, in our reform processes, we have made provisions in other laws that does not encourage this to happen, and we need to step back and be able to set every organization of government back to the position of the Constitution. And I hope that the legislature looks at this. So in closing, I'd like to say that what we have proposed here are modest changes, but more fiscal reforms are still in view. We could not take in every, we have so many proposals that came from different quarters, agencies of government, several stakeholders, and we carefully selected a few, and our aspiration is to do a midterm review in 2022, and the possibility of another finance bill mid-year 2022 to bring in more amendments. The reason here is key for us. There's a lot of, we have some issues in the fiscal space which are disagreements between the federal government and the states relating to VAT, relating to stamp duty. Some of these issues are in the courts, and therefore we have stayed clear of those issues and have not made any provisions amending them. So we're hoping that by the middle of the year, some of these issues are clearer. Either the courts have taken a decision or there's a political decision, and then we can revisit the provisions that require to be amended at that time. And then any other thing that stakeholders feel are really key for the implementation of fiscal reforms in our country. So we must continue to, we recognize that we must continue to diversify our revenue away from the oil and gas to fund critical expenditure. And I should report to the Finance Committee that as at September 2021, the federal government retained revenue was 4.56 trillion. And this is achieving 75% of the budget prorated target as at that time. The federal share of oil revenue was 845 billion, representing 56.3%. That's the oil revenue prorated performance, while the non-oil revenue prorated performance at 1.31 trillion is representing 117.2% above budget. This is signifying that the reforms and all the work that has been doing is actually yielding results, that the non-oil sector is performing better and stronger, and that we have an opportunity to do more in 2022. Clearly, our ongoing reforms of the past 6 years are yielding tangible results, and we need to do more. However, the Federal Ministry of Finance, Budget and National Planning is closely following the issues and developments on policies. And these legal developments and pronouncements, of course, on VAT, as well as on state sales tax, current fiscal policy stands to let tax incentives with sunset provisions to naturally expire and not to automatically renew such incentives without a detailed tax expenditure cost-benefit evaluation of the related success of the incentives before extending further investments. So there's an ongoing work on review of investments to have a view as to what are the achievements of these incentives that we have been providing over time. We're also working to accelerate projected increase of tariff and excise duties, such as taxes on alcohol and tobacco, and also the consideration of excise duties on carbonated drinks to fund vital expenditure on health, on education, and on security. So this aspect is not provided in this bill because we realized that there were so many stakeholder interests from both sides, especially relating to carbonated drinks, and we thought let us do more stakeholder consultation before provisions of this is done. And the wholesale reform of antiquated stamp duties and capital gains tax also should be revisited. So there might be a need to just take the Stamp Duties Act itself by the Parliament and review it, take the capital gains tax regime and review it holistically, rather than the piecemeal reviews that are currently going. There's also the possibility of introducing new taxes, new tariffs, new levies, as the economy is now on a recovery path. So while these issues may require modest increases in taxes and tariffs on certain business sectors, industries, or even on individuals over the medium time, this administration remains committed to continuous dialogue and engagement with all stakeholders and interested groups, particularly the two houses of the Parliament. Chairman, honorable members, this is my presentation. We don't understand if this is an amendment on the value-added tax or the Nigeria Police Trust Fund Act. Because what we have here is Section 4 of the value-added tax is amended
We don't know if that is an error or an amendment to the Value Added Tax or the Nigeria Police Trust Fund Act. If that is observed, okay.
Madam?
So the only provision that we have here relating to the Police Trust Fund is Section 34 of the Finance Bill. Subsection 4, Section 34, subsection 4. Page 32. So page 32 has the Nigerian Police Trust Fund Establishment Act. So the amendment is set out at page 32, section 34.
So we were working on the bill that was forwarded to the office by the Joint Committee on Finance. And what we have here is an amendment to the value-added tax. Sir?
Does it mean you're not consulted at all?
Not at all, sir.
Madam, we are also here. We can also give you another copy. And of course, we advertise every section of the bill.
Section talks about CIT.
In 3 papers.
Value-added tax.
Clearly stated. Yes, 6 pages per paper. So there's no way you are going to have 2 versions. Maybe somebody copied from social media and sent it to you. What we have, if you go to page 32, are you there? You see that your what you read before is completely out of this document. Are you okay now? Thank you. We're manufacturing different versions.
We got it, sir. Maybe it was not the final one, and the letter didn't have any copy of the new. So we were reacting to this one, sir.
Thank you.
Thank you, sir.
Anyway, you still
Yes,
have to this
catch it.
evening to submit your.
Yes, sir. Thank you, sir.
Any other, please?
Distinguished ladies and gentlemen, my name is Tajuddin Akonde. I'm the managing partner of PKF Professional Services, accounting and tax practitioners. I would like to begin by first permit me to stand on existing protocol and to express appreciation to the Honorable Minister and the team for keeping up with the commitment to accompany the annual budget with a Finance Act to support its implementation. Now, on the current bill that we are reviewing, of course, there have been some changes, and I would just like to speak to a few areas where I think the committee will take a second look. Particularly, I will be addressing the changes proposed as Section 30 of the Capital Gains Act, which brings disposal of shares gain on disposal of shares into the tax bracket. Also, the issue of the minimum tax as it relates to the period covered by the COVID relief that was proposed, the COVID relief that was proposed in the 2020 Finance Act. And a bit of some clarification as regards the insurance company at Section 16 of CETA. Now, on the capital gains tax on shares, of course, this is a major policy change, and we expect that there will be a lot of public reaction. I do understand the basis and the policy trust, but for implementation purposes, a major concern for me and those of us in practice is having different tax rates. Capital gains tax has always been 10%. Now, in this bill, we are proposing 5%. And I have the advertised bill, and it says the threshold is 500 million disposal proceed. I had the minister mention 500 million capital gains, 500 million of gain. And there's a difference between the threshold based on the proceed and the threshold based on the gain. So the committee needs to look at this so that there is clarity as to what the threshold is. And what we are advocating is to limit confusion and the ability to maneuver, which will make implementation difficult if we can keep a single capital gains tax rate. The second issue regarding the period covered by reducing the minimum tax from 0.05% of the turnover to 0.225, half of it, the 50% relief. I believe the intention was to cover 2 years from the year of the COVID. We had COVID in 2020. Now, I guess where the confusion is coming from is the use of financial year in some places and the use of year of assessment. For tax practitioners, we do understand the difference between financial year and year of assessment. Companies, after the commencement period, are assessed on preceding year basis. So when you say 2019 year of assessment, we are actually speaking to 2018 financial statement. So if the relief is intended to give succor to what happened in 2020 and for 2 years, we should actually be talking of financial year 2020 and financial year 2021, meaning 2021 and 2022 years of assessment. So please, we need to look at this and be consistent, whether we are talking of year of assessment or we are talking of financial year. After the release of the last year's bill, we have a lot of confusion and calls from clients seeking clarification. And I'm aware that a number of companies complying with the 2020 Finance Act had actually claimed those relief on their 2019 accounts, which means, in effect, that the Act was having retroactive effect. With this bill, are we going to be making a refund? So please, we need to look at it and not make another mistake in the wording. The wording was what caused that mistake. If the intention is to correct that, please, let's look at it and be professionally guided. Mr. Chairman, sir, in the proposed amendment for insurance company on section 16, the subsection 1, add A, B, and in C, it says, generally, the profit on which tax may be imposed for an insurance business shall be in line with section 13 of this Act. We are of the view that that section, subsection C, can actually stand alone as subsection 2, because it does not actually go with A and B. And of course, we may have to remove the word generally. This is legislative document, and the wording should tally with what I guess the lawyers can properly frame it, as against writing prose like a novel.
All right, Minister, you may wish to respond to some of these observations by PKF.
The amendment that is required there is very simple and basic. It says subsection 2, section 2, subsection 2 of the Act is amended by replacing the words 30 days with 60 days. And the essence here is just to align the due date of payments for filing of company income tax. As it is now, companies file company income tax and then another 1 month after they filed VAT. It's just to align the date. Companies are saying, why can't we do it at the same time? It reduces their workload. So that's the only amendment in the TED Fund Act. And then the next one on the Nigerian Police Fund Trust at page 32. The amendment is seeking to amend Section 4 of the Nigerian Police Trust Fund Establishment Act, and what the amendment is doing is to provide a framework for the administration of the fund to enable FRS support the fund to collect on their behalf. That's the only amendment that has been made. So there's nothing relating to VAT, madam. The
only difference may be that FRS will collect the fees. Cost of collection. Or is it free?
May I ask the chairman to...
FRS, is it free?
Chairman can respond on that.
4% cost of collection, sir.
You have to sit with the agency to agree. Thank you.
Very well noted. But I think the important thing to point out, of course, is that he's actually not against the introduction of the capital gains tax. He's saying that the rates should be kept at 10% instead of 5%. One rate, yes. Yes, but we are saying that the 5 was introduced along with the principles that have come across the Finance Act since 2019, is to do things gently, introduce changes gently, so that you don't discourage people and you enable the process to begin to go on smoothly. So the 5% was introduced so that those who have not been paying those kind of charges before would begin to factor it into their considerations, because they haven't paid capital gains tax on shares for a long time. So that was the real reason why.
10%?
Yes.
So why are you going down to 5%?
Again, as I said.
The issue is this, implementation. How is it going to be easy for implementation purpose? Why can't you just use a single rate? And we are interested in more revenue.
Well, the Honorable Chairman, really, it was zero. They were paying nothing before. And we thought, let's attract them into this net first.
Established rate. Just
old.
There's an old rate which everyone is already used to. We can start from there.
Anyway, it's capital gain. Capital gain.
Yes.
Just pay 10% of your profit. Chicken off.
In any case, there are provisions, sir, for rollover. We encourage you to continue investing it. So if you don't want to pay a higher rate, maybe you will reinvest it.
Oh, really?
Yes, there are rollover.
There's
rollover relief.
If you roll over, you don't pay.
Yes, it doesn't apply.
Until you exit. So you will continue to defer our revenue.
No, but we are also trying to retain investments. We're trying to discourage the issue of people coming in when the market is good and exiting. Yes.
Okay, so where you don't want to roll over, what rates?
Honorable Chairman, as I said, we were looking at 5%, but if the committee in its wisdom thinks that we should keep it at 10%, I think we'll just have to comply with that.
All right, thank you.
What we discovered is that last year there was a slight error in transcription. The provision sent was about financial years, but in the process of finalization, the issue of year of assessment crept in. So what we found is that that was the law. So some companies had complied with the law. So we felt that in the interest of clarity and tax equity, what we should do is to allow companies to take any 2 years from 2019 to 2021 And the lawyers advised us that you cannot, if someone has benefited from a law, you cannot retroactively remove that benefit. That was the law of the land. So we are saying that in order to give clarity, we'll put the year's financial year to be clear, but also to be clear to say if you benefited in 2019 because of the law, you can still benefit for 2020. But if you did not benefit, you can benefit 2020 and 2021. So the idea, the improvement there is just to give that clarity that he was requesting for.
FRS, you are the one on the, actually practicalizing this law. How was it?
The main point is that there are people that have benefited, and the second issue is that you cannot make law that will have retrospective effect. So the challenge we have in hand is that if the provisions made, the proposal made by us is not considered, the FRS is now going to face a situation whereby taxpayers will write us to request for refund. And I think currently the total refund given to us from the federation account in a year is about 25 billion naira. So if you have a taxpayer who has already paid 25 billion as minimum tax, I'm just giving an example, and you have some other taxpayer that have either wrongly or by mistake or deliberately have paid VAT into another account, or the tax belonging to Kaduna State, for instance, into Federal Inland Revenue, where do you get money to make a refund to that person? So it is actually going to create slight administrative issues for us if the proposals made are taken. At the same time, there is legal implication because you don't make law that will take retrospective effect, retroactive effect.
Thank you, the chairman, the honorable members, the honorable Minister of Finance. Permit me to carry on existing protocol. The proposed amendment on Naseni Act is on the Financial Bill, page 33, serial number 35. And also to save the committee time, I'm going straight to page 3 of our submission. The financial provision of Naseni Act has never been implemented since the agency's establishment in 1992. The administration of President Muhammadu Buhari, in line with its economic diversification and focuses on science, technology, and innovation for solid industrialization of the country, has demonstrated adequate political will to achieve this. The government has shown commitment by implementation of 1% of the Federation account in the first instance, commencing in the 2022 fiscal year. We therefore appreciate government for the confidence in Naseni's ability. We in Naseni have understood the wisdom and strategy of government by commencing with this component and deleting aspects of Federal Inland Revenue Service Industrial Levy. That is section 20, subsection 2, subparagraph B of Naseni Act. My conclusion, no doubt, what can bridge the gap between developed and developing countries is substantial investment to acquire and deploy capacity and capability to transit to a manufacturing economy. The COVID-19 pandemic has exposed the weakness of the third world nations and motivated some developing and developed countries to take full advantage of global meltdown and transit faster and earlier into fourth industrial revolution, thus expanding the science, technology, and innovation dichotomy. This is a gap between the rich and poor countries which Naseni is strategically positioned to reduce or close. Thank you very much, Mr. Chairman.
So if I may read, sir, if you look at in fact, from from 2, without prejudice, the gains are accruing on disposal of the shares, then moving on to say first where the proceeds from such disposal are, then in B, the disposal proceeds. So it's clear that it's intended to be on the proceeds, sir.
Everything is fine. Other stakeholders here, we are okay with. Are we all right? All right. Honorable colleagues, any further questions to the general public or the minister, to anybody, apart from Honorable Osai?
There is a misunderstanding within Nigeria Customs Service and the automobile industry. There are lots of complaints to my office as the Chairman House Committee on Customs and Excise that customs are still taking the Hilux van to be luxury vehicle, and they still charge levy of 5% on them. And the Finance Act didn't stipulate that. I don't know what is the policy that was transmitted to customs. So I want to ask the Honorable Minister if you can avail us.
You as Chairman of Customs, you should be able to answer this question.
Yes, I have told them it's not a luxury. It's not a luxurious vehicle. It's a vehicle that is we can also classify as truck, part of truck. So, but the customs change the story, and you cannot control them except there is another policy stating clearly what's supposed to be from Ministry of Finance to Customs.
According to the law. We don't want to overburden the Honorable Minister.
Sir, you know, Customs is under Finance, so, and except Finance give them, publish it for people to see, Customs will continue to claim that that is what is transmitted to them.
Okay. I think you've made the point very clear. You want Ministry of Finance to make it public as to the status of such vehicles. Yeah, Honorable Kuya, please.
I'm referring us to the document presented by the Honorable Minister, Key Policy Trust on International Taxation. My worry is just, and maybe the Chairman FRS would tell us whether FRS is ready to undertake this task, because anything IT, you have to be ahead of the person you are supervising or you want to take money from. I'm specifically talking about taxation of e-commerce business by non-resident companies on a fair, reasonable turnover tax basis of 6% of turnover. Is the FIRS really ready for us to undertake this tax? Because for you to do that, IT-wise, you really have to be ahead of these companies. If you want to take money from Amazon, for instance, and all that, you really have to have something in place. And I will check that. Then on the same document, page 11, the issue of excise duty on carbonated drinks. Honorable Chairman, the Honorable Minister and the team, you should really have to accelerate on this issue, because as a member of the Customs Committee, we are really looking at this area, and it's one of the revenue lines that we're hoping to get more money for the customs. And we want to pursue that in 2022. But with this submission from you, it appears that we'll have to wait a little. So please accelerate action. If for nothing else, at least it will reduce diabetes in this country, the level of diabetes. Honorable Minister, I thank you very much.
Thank you. Honorable Minister, closing remark, and then we can allow you to go. And then we revert to our executive sections and take a more critical look at the law. and present our report accordingly.
We will be on standby if you require our presence for any clarification. We will be available to support the work that you are doing. And we also appreciate that what we have is a proposal, and that you'll be doing your work of making the law. And we do hope that this is something that will actually come out along with the budget in the hope that, as Mr. President, and we have taken notes very copiously of the issues that are raised. Just to commit to the Finance Committee, Customs Committee Chair, we will send you the conveyance that we made to Customs. I hope you will also give me a copy of the bill that you are considering tomorrow. I'm trying to find it. Okay, all right, thank you. Okay, thank you very much. And please, if you will forgive me, we have the same hearing tomorrow in the Senate at the same time you called for that. So our PAMSEC and the technical team will be with you tomorrow, and the CG Customs and his team. But I'll be in the Senate doing the same. Okay, yes, that's a possibility. So since Chairman said I should do my closing remarks, all I'll say is thank you very much for giving us this opportunity. Thank you.